Good morning. Welcome to our webinar on the long-term agricultural outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and on behalf of the Center and Purdue Extension, I want to welcome you to today's webinar and introduce you to our panel. Joining me today on our panel is Dr. Chris Hurt. Chris is an extension economist and a professor of agricultural economics here at Purdue. Also joining us is Dr. Jason Henderson. Jason is a professor of ag economics as well and also director of Purdue Extension. And my colleague, Dr. Michael Langemeyer. Michael is a professor in ag economics and also the associate director of the Center for Commercial Agriculture.
Good morning.
So our webinar today is really going to focus on the long-term agricultural outlook and really trying to take a little different view of the agricultural economy than we typically do. We tend to focus on things a little more short-run oriented. Today, it's really going to be the long view. And as you move through the course of the webinar, if you have some questions, you can email those to me. And I will be monitoring my email during the course of the webinar, and you'll have a chance to perhaps pose a specific question that you'd like to see the panel address during the course of the webinar. If we're unable to get to it today during the webinar, we'll respond later today by way of email. So if you have some questions, feel free to email those, and I'll be checking those during the course of the webinar. So Jason, let's kick it off and talk a little bit about the state of the ag economy from kind of a broad perspective.
Yeah, so I think right now what we're looking at is in the short run, the farm boom is over. We have low interest rates and we have low inflation. But we also know that long run, we're going to have 9+ billion people in a different market environment. I think the interesting aspect, though, is really thinking about how do we get there? This transition from the current short run environment to where we are long term. And a lot of the questions are surrounding are similar questions that we've had in the past. Monetary policy, inflation, interest rates, how does that affect agriculture going forward? As we look at the different dynamics and dimensions, in many ways history might not repeat itself, but it does rhyme.
Yeah, so the transition is really the key, and how do we move from what has been a historic profit era in agriculture, especially crop agriculture, to one that looks quite a bit different. So let's think about that a little bit as we go forward here.
Right. I think one of the things that people are looking at is what's the impact of interest rates? And from my perspective, the only way we're going to get interest rate movements if we start seeing some inflation. And so when does that potentially happen? And when you look at it from a macro standpoint, you start getting inflation when the U.S. economy starts stretching and approaching its potential. And since the recession that it started in 2008, the U.S. economy has been operating below potential. But if you look at the longer term forecasts, what it seems like is that as the economy continues to improve over the next couple of years, it's a time frame about 2017, 2018 when the U.S. economy starts reaching its potential. That's when you start getting those inflationary pressures and when the Federal Reserve really looks at starting to raise that interest rate perspective.
So Jason, we've talked for some time on some of our past webinars about the risk of interest rates going up. Mm-hmm. And we've been wrong from the standpoint of we've anticipated rates going up more quickly than we've expected. What's different this time versus perhaps last year or maybe 2 years ago?
I think the biggest difference is where you're looking at in terms of the gap between potential GDP and real GDP. Of where it is. And right now you're looking at unemployment rates that have fallen. And so every time that we get unemployment rates that come in a tick lower, whether it's those that are the regular unemployment rate that we look at, that's the headline, or when you start putting those that have exited the workforce, those labor participation rates. Once those start getting, every time they go lower, then you're starting to stretch your capacity and your workforce capacity. So we really need to start thinking about wages and how does that in play and look toward inflation.
And you think we're getting close to that now, maybe not quite there, but certainly getting close to that, and that leads you to think rates are headed higher these next couple of years?
Yeah, I think it's looking at where wages are. You're starting to hear of some companies at the end of the year, this last year, where we said wages started to increase a little bit, more than what they had the previous couple of years. But it's really wages going forward that's going to drive a lot of the inflation, because when people have more money in their pockets, they spend it more. And that's the start of starting to pay for higher prices for the goods and services they want.
And that'll be the real signal to the Fed about raising rates.
That would be the real signal to the Fed.
All right. So let's talk a little bit about the interest rate risk in agriculture.
Yeah. So what you're looking at now is one of the advantages that we have this time around compared to what we were looking at the 70s and 80s farm boom, is that the Federal Reserve does put out an interest rate forecast, a long-term forecast of where they think interest rates are going to go. And so if you look at it long run, all the different votes, are shown on this chart looks like that they expect interest rates to go from about 0.25% of where they are today on the short run basis for a Fed funds rate to 3.5 and maybe even up to 4% out long term. The challenge is what's the path that they take to get there? How quickly do they get to the long run? And that's where there's a little less agreement and more dispersion on this chart of where the votes are in terms of these dots that are represented on this chart.
So Jason, let's back up for a second. Let's explain this chart a little more clearly. What's going on with the dots on the chart? That's not quite obvious, perhaps, to some of our viewers.
Yeah, so if you're looking at this chart of the Fed funds rate, each dot represents a vote from the Federal Open Market Committee member of where they think interest rates are going to be at the end of 2015, 2016, 2017, and in the longer run. It's a committee. Votes matter, and so you have to have a majority votes in order to move interest rates up. And so trying to get an idea of looking at where that midpoint is of where the majority of the votes are in terms of where interest rates are going forward. And so you see from the chart they expect interest rates to go up a little bit in 2015. But 2016, there's a broad range where one voting member says interest rates will remain at about 0.5%. Where another couple of voting members think that interest rates by the end of 2016 will reach 3%. And so this is really kind of looking at which path is correct. And there's a wide variety here, and that carries over through 2017. So, but long run, I think it's interest rates higher about 3 to 4 percentage points.
And we do note in the long run they get more clustered. In other words, we don't know exactly the timing, but longer run they're more clustered at higher rates. And I'd ask the question for the farm sector, for agriculture. If you get this kind of change in the federal funds rate, what are the implications for lending rates at the farm level?
Yeah, so as these interest rates rise, you're going to see farm level interest rates rise at a similar path. So if Fed funds rates add about 4 percentage points to their levels, you're going to look at farm lending rates add about 4 percentage points to their levels. So if you're paying, thinking about 4% for a farmland loan today, looking at 8% in a couple of years.
Yeah, so if you think about it then, I think what we're arguing is a scenario where people in agriculture should look at their cash flows, look at their debt structure, and ask themselves what would happen, how would I manage in an environment where rates are going up 3 to 4% over the next perhaps 3 years or so is kind of the time frame that you're suggesting?
Yes. Yep. And so I think there's a couple of implications. Higher rates tend to raise the value of the dollar, which tends to impact our exports historically, everything else held constant. So that has an income impact as if exports are affected. And higher rates tend to affect the balance sheet and the collateral that we have, as higher rates tend to lead to lower farmland values.
Yeah, so it's big changes. And we'll talk a little more about some of those impacts a little later. Let's talk a little bit about the world economy and how that could impact U.S. agriculture the next several years. Yeah.
So what we've seen, I think, in recent years has been a huge, strong, really growth rates in South Asia, China aspect of the world economy. And when you look at World Bank forecasts for the next decade, from about 2015 to 2024, you're starting to see some changes in the economic growth aspects from across the globe. You're looking at China's growth rate slowing from where it was at about double-digit rates for almost 2 decades to down to about 7%. You're looking at South Asia's growth rates being flat and holding constant. But the real change is, if you look at the right-hand side of the chart, it's really in the Western Hemisphere. Latin America, North America, having stronger growth rates over the next decade than what they had over the past 10 years. And maybe a modest rebound in Europe going forward.
So let's think about the implications of that for U.S. agriculture. When I look at the slide, I see the positive growth rate for the world, but then I see some downturns, or at least weaker growth, in some of those key export markets for the U.S. And so what are the implications there for U.S. ag?
So I think for U.S. ag is, over the past decade, we've gotten used to Asian markets being the hot market of growth, a lot more export activity going on in there. And we'll still get growth, but it might not be as robust as we've had over the past decade. And we have to think about, I think, our other developing countries, especially in the Western Hemisphere. What's going to happen in South America, Latin America, and what's our ability to export into those markets? And how is consumer demand going to change there?
Yeah, so as we think about it, maybe some headwinds compared to what we were facing over the last decade. We really were tremendous beneficiaries of the extremely rapid growth taking place in China. Going forward, maybe not so much. Certainly the next 5 years or so. Okay.
Right.
All right. Let's talk about exchange rates a little bit. You mentioned it earlier. Let's bring it back into focus a little more.
Right. When I look at exchange rates and you think about the dynamics that we have, you have this dynamic, what's going to happen in China? I mean, that's been our number one key export over the last few years. Is China going to be a consumer or a producer-driven economy? How do their economy changes? And so if you're a consumer-oriented economy, you like a strong currency because it allows you to buy goods from other countries cheaper. And allows you to keep your inflation rate low and to increase your standard of living. At the same time, if you're a producer-oriented economy, you want to have a weaker currency because that makes your goods cheaper to sell to foreign consumers and allows you to grow your economy through production, manufacturing-based activity. And so when we look at China, their perspective has been they've wanted to be a producer-oriented economy. They've been export-based. And so, but as their economy evolves, as they have become more consumer-oriented, does this lead to a shift in their exchange rate, especially compared to the U.S.? If their currency goes from a weaker currency position to a stronger currency position, does that allow U.S. agriculture to export even more to China simply because of an exchange rate movement?
And the discussion we had before the webinar this morning was, and it seems like there's an announcement about China every couple of weeks that could potentially impact us. The big announcement this week was dropping the one-child policy. It's pretty quick to make some analysis on that one, but I think it's useful in the context of what you were just talking about to think about what could be the impact of the one-child policy, especially longer term, right? Maybe a decade out.
Yeah, so I think what we're going to have is, with the elimination of the one-child policy, you're going to have more people. And that's more mouths to feed and maybe more potential demand, especially when you think about a decade out when, people sometimes say the real consuming power is amongst those teenagers.
So more pressure on China to become more of a consumer-oriented economy and a little less oriented towards the production side, perhaps?
Yeah, and that could be a potential opportunity for U.S. agriculture to see some strength in exports over the next decade.
Yeah. So longer run, some good news there. Short run, the outlook for China is not as positive, at least compared to the last 10 years.
Yep.
So, Chris, you've been looking at the exchange rates as well, and so this is the dollar index using the monthly chart going back roughly 10 years or so. Walk us through that a little bit.
Well, again, we do see these inverse relationships between the dollar and commodity prices. Now, this is just showing the dollar as you suggested, and we've marked a couple of places where we had the weak dollar, particularly 2008 and then into 11 and 12. Again, if you go back and look at the corn price peaks, the soybean, wheat price peaks, those came price peaks when the dollar was really weak. So agriculture in the U.S. is an export-oriented industry. We have surplus production and we need that foreign market. We generally see when our exports are strong, farm incomes are strong. So this is really an important relationship when we look over on the right-hand side and see the strength of the dollar currently. It tends to be a negative time period for prices. So again, as we go forward, what are the prospects? Looks like the U.S. economy, as Jason talked about, even longer term, may be doing fairly well on the growth side of things. And if interest rates go up, these are supporting a strong dollar going forward. So another one of the headwinds that we face in an export-oriented industry like U.S. agriculture.
And a big swing, looking at the chart, a big swing in roughly the last year and a half, right? A big portion of that increase in the value of the dollar has taken place in a short span of time.
And of course, this has a lot to do with what has happened in this last year. And again, a very heavy headwind for us in the next 1, 2, 3 years in trying to get that volume of exports we need in our surplus production industry.
And we'll talk more about this later, but we've seen some impacts already. We were talking
Some
earlier
big
today,
impacts.
Especially in some of the meats like beef. We've seen some big swings, and part of that was motivated by what was taking place in these dollar values. Let's look at some of the changes on the individual country basis, a little more detail.
Sure, and again, why don't we start over on the left-hand side of this visual to we've talked about kind of the macro side and the long-term income growth, and started talking about exchange rates, but let's also think a little bit about the commodity world that we are in now. So it is a low price time period for commodities in general, and it's not just a low price time for commodities. We still are dealing with a high cost structure, as we know, in our agricultural crop production sector at this point. So let's think about, why do we have low prices? Well, one of the first reasons we have low prices is world production for about 3 years now has been outpacing use. If you are in a situation where you're producing more than you're using, guess what? At the end of the year, inventories are building. So again, a big change from the boom period that we went through when supply couldn't keep up with demand. We've now hit basically 3 years where supply is exceeding the use that we have, and we're building inventories. That makes all buyers more comfortable that there's going to be a reasonable supply of inventory. The other thing we still deal with is that the boom period results in higher cost, but those costs tend to lag. They don't immediately move up with the higher returns, but over time they do. But we also know costs don't immediately move down when the prices of commodities move down. So we're still dealing with a legacy of very high cost at a time when the revenues are low. So that is one of the big issues. It's just a simple supply and demand issue with costs that are still very high and lagging that we think will probably have to change in the future. The weak world demand, we've really hit that point. The slowing of growth in particularly China, a real driver. The strong dollar. And again, I think in agriculture, we're pretty highly correlated if you look at agricultural grain prices with oil as an example. Now, those aren't perfect correlations, but they're reflecting the same kind of tones of the macro economy and the dollar exchange rate. And so we see this now period of excess low oil prices, low energy prices, and agriculture in the boom period joined into the energy markets. That was part of the rise. Now the decline in energy markets has to be part of the resetting that we're going through at this point. We can't overstate this exchange rate issue, I think, and we'll start over on the right-hand side of that visual talking about our buyers, and I think this is pretty well understood. China's our big soybean buyer. Their currency is 4% lower over the last year versus the dollar. So if soybeans were priced at the same level a year ago and today, they actually cost 4% more for the Chinese. Japan, Mexico, and Korea are our three leading corn buyers, and you can see a 10 to 20% drop in their buying power of those currencies. Those are pretty big headwinds. Now we go and look at the competition side that we face, and here we have some huge numbers, particularly Brazil. Brazil, major soybean exporter, probably going to be the biggest exporter of soybeans in the world, passing the United States this marketing year. But look at that decline of 40%, the Brazilian real down 40%. So what does that mean to China as an example? If you think about China, when they're buying beans, if they were priced the same in the U.S. A year ago and today, they had to pay 4% more. Basically, if they buy them out of Brazil, they're 40% less. Those are not just headwinds, that's a tornado or a hurricane facing us. So I think this issue of what is going to happen to our exports, and that's important on grain, but we also need to talk about the animal sector, and we're going to do that a little bit later. So these are some I think, more than just headwinds. They are big concerns. Russia, that's all tied up with the sanctions that the West has put on Russia for their incursions into the Ukraine. But still, we compete with Russia for some corn exports, but particularly wheat exports out in the world. So again, these are big factors that just simply were not there 4, 5, 6 years ago.
And so, Chris, you look at the chart, and I think for probably most of our viewers, what jumps off that chart is soybeans. When I think of Brazil and Argentina, tremendous competition in the export channels for the U.S. sector, and some negative implications about soybean values in the U.S., not only in the current crop year, but perhaps longer term.
And we're seeing this right now in terms of planting in Brazil. Again, their low value of their currency, they sell in U.S. dollars, their soybeans. That converts back to a lot of Brazilian real. So this is actually stimulating additional plantings of soybeans in Brazil in particular this year. So it's encouraging our competitors, it's hurting our buyers of our agricultural goods. And again, we can't miss that in terms of what it means to our prices.
So how long, one of the questions that I've had is how long is this environment usually sustained? You know, when you talk about fluctuations in the dollar, that's one of the concerns that I have is this going to be a temporary thing for one year, or does this kind of change dynamic, or how quick that transition to a longer term environment that we move to?
Yeah, and again, I think we probably have talked about, particularly Jason, as you were talking about, what does the U.S. economy, how does it do relative to some of these other economies?
Yep.
And the Brazilian economy, again, has some shorter-term problems. It's likely to recover some from that. We talked about the Russian situation, why that ruble is down so much.
Yeah.
And again, hopefully that we bring Russia back into the world environment and that we get back to trading and allowing freer trade with Russia.
Yeah.
On the other hand, I think we're looking at the U.S. economy coming out of the Great Recession has actually recovered better than much of the rest of the world,
Yep.
Europe and Japan at least. That interest rates probably relative to interest rates in other countries, maybe for 2 or 3 years.
Yeah.
So I think you're talking about the relative value of the dollar will stay reasonably strong. We're not going to go back to that weak dollar
Yep.
in the next 2, 3, 4 years.
Yeah, I always think another factor too is with the U.S. dollar is we are the safe haven currency. When there's troubles across the globe,
Good point.
people fluctuate, come to the
Absolutely.
U.S. To buy assets, and they need dollars.
So, Chris, thinking back to your dollar index chart we had up on the screen a couple of minutes ago, I think we just made a case for us staying at that relatively high dollar value on that index chart for the next several years, based on largely on the macroeconomic outlook here in the U.S. relative to the rest of the world, right? So,
I think that's right. And again, there's going to be fluctuation, we know that, but relative to where we were in 2008, 2010, 11, strong dollar.
so Jason, at the start of the downturn,
Right.
the discussion among a lot of people was this is going to be much different than some previous downturns because we were entering it with such a strong balance sheet and farm finances were in such strong condition. You've got a chart here that suggests maybe that's changing.
Yeah. So I think the financing picture is changing. Finances in agriculture are strong, but it's some questions about how much strength we have going forward. You know, when I talk to bankers, in 2010 and 11 during the high point of the boom, a lot of them were talking about there's plenty of cash. And so when you look at this chart of farm debt outstanding at commercial banks, there was no growth in farm debt at commercial banks, and that's both in the non-real estate and the real estate. There was just no growth that was there. But what we've seen over the last couple of years, and especially over the last 12 months, has been a different picture. And so if you're looking at it, you've seen growth in farm debt, mainly for non-real estate or that operating loan lines, going up about double digits. And I think a lot of that is concerning because what farmers are doing is they have negative margins. Are they rolling that loan? Going forward. And the question is how long can farmers roll that loan if they need to, if margins stay negative going forward? And so that's what we're starting to see is that where's the cash in agriculture, and if farmers are starting to increase the debt and starting to use that to pay for their operating lines more than what they're using for cash, I think there'll be some major dynamics. How much of the crop inputs are going to be prepaid this fall? Probably not as much as what it was in past years. So you're seeing a lot of different dynamics that are happening in there just from a farm financial picture.
And another thing that we've seen, Jason, is we've seen large inventories of crop and storage. But it does, if losses are $150 to $200 a year, which they could be for 15 and 16 for some producers, it doesn't take long to erode that inventory. To try to pay bills, and so even though that's very strong for a lot of farms, it doesn't take very long for that to be eroded, and then that would also factor into increasing operating debt.
Yeah.
And I think we're sort of at that point where they did have cash, but as your point, this is probably going to go up pretty sharply now in the next 2 or 3 years, at least with our outlook of tight margins.
Yeah.
And part of what takes place here is that on an accrual basis, we saw a big drop in 14, but on a cash basis, that really didn't start showing up until a year later.
Exactly.
And so it's really hitting home now in 15, excuse me, and it will hit it home again in 16.
Yep.
So that chart's going to continue to look worse and worse the next couple of years, and really going to create some challenges for some individual operations, right?
Yeah, it is. And if you look at some of the forecasts from the Federal Reserve of bankers, ag bankers across the country, they're expecting a higher number of loan renewals, and they're expecting lower repayment rates and increasing farm operating loan demand. So those are all kind of moving in that direction of farm debt's going to accelerate over the next year or two.
And I want to go back to an earlier chart that you had, Jason. You were also looking at higher interest rates, and so it looks to me like you've got a storm brewing here. Margins down, plus you have higher interest rates, so it's harder to pay off the debt, and so we've got some repayment issues. At least for some operations, are going to be very difficult.
Mm-hmm.
And I think we're all thinking about we're in a transition period,
Yep.
and that the lender is going to be a really critical factor, we hope, in making the bridge from where cash flows, et cetera, liquidity is going to be a real big issue for the next couple of years. But again, we've got to get back to better equilibrium, as Mike was talking about, where you get back to closer margins where our revenues are covering the cost. So a couple of years where the lender, or maybe more than a couple, are going to be really critical.
I agree.
Chris, let's take a look at kind of the long-term picture. You did an interesting bit of analysis here this past winter, and you've updated it more recently. Walk us through what's taken place here.
Yeah, and again, what we've gone back, this is 115 years of data on inflation-adjusted corn revenues per acre in the United States. But we're looking at those boom periods where revenues per acre just shoot way up. And one of the things about something moving up is that there's a downside to that. And we just look at the right-hand side in the kind of boom period and what we have projected out through 2018, largely based on what futures markets are saying for corn going out the next several years, is that the boom returns to more of a long-term kind of cost structure. And so we'd call this a boom followed by a moderation period. And I think that would be a good thing for us to discuss a little bit. The moderation, how far down do you go? Particularly look at more in the middle part, the 70s boom, and then really a bust where you go down below that long-term trend line for a considerable period of time. Like that's 20 years. Are we going to go through a really downside like that, or will it be more like a little bit to the left of the middle? That's the 1940s, 50s, and then kind of getting back to the long-term trend. That's moderation. That's a lot easier to adjust to. So I think we're ripe for discussing that. I think my best guess is we'll moderate. That's still a lot of adjustment as we're talking about, but not as bad as what we saw in the 1980s bust.
To put that in perspective, though, Chris, we had a discussion before the webinar started. Compared to our forecast a year ago, we were saying moderation at that time as well, but we've run into some more significant headwinds over these last 12 months maybe than we were anticipating. So the outlook does look less rosy going forward today than it did roughly 12 months ago, right?
Well, I think some. Again, I would really be hesitant to be talking about a really major bust, anything like we saw in the 1980s. And again, we can talk about land values. How would this play out? What percentage of farm families had to give up in agriculture in the 1980s versus what would we be talking about this time? We also have had two very good near record yields of our crops, particularly corn and soybeans. So I think that contributes to a little bit weaker price structure than maybe what we'd been thinking a year ago. So I still like to stay with the moderation. I think it has turned a bit weaker for the next 3 to 5 years, but there certainly are differences of opinion on that.
Yeah. Well, I think I agree with Chris that there's going to be the 40s and 50s scenario is probably the most likely, a boom followed by a moderation. But I think what we've learned over the last couple of years, if you're just looking at the housing sector, you can't ignore some of those black swan events, the low probability with a big downturn events that could potentially come up there and hang out there.
And so from a management standpoint, I think what we're really doing is building a case for some scenario analysis, some stress testing, if you will, and thinking about how a weaker economy, perhaps even a little weaker than our median forecast here would suggest, in an environment with some rising interest rates, what would that do to your operation, and think about how you might respond to that and have those plans in place and get ready to pull some triggers if it looks like you need to. So we'll talk more about some of those strategies in a future webinar, Michael, but certainly something to be thinking about as you think about this outlook.
And I don't want to be too much of a bear here, but even the moderation scenario that you guys are talking about, we're still looking at not being close to break even until probably 18, 19. Depending on where corn price is in 18, 19, of course. But we're going to have some transition years here where losses are going to be rather large.
And that
means, I think that's the basic point, that this it's not a bed of roses what we're going to go through, and it's going to vary from family to family how much adjustment. Some of that's going to depend on how locked in were they, how much did they lock in their equipment, high land values, locked in the high cash rent for 5 years. And how much can they adjust if some of those costs would come down?
Right.
So let's take a look at the world crop situation, because with this downturn in prices, I think a lot of people have been expecting to see some response on the acreage side. But Chris, the data you've put together suggests a little different scenario.
Yeah, this is world harvested acreage of 13 major crops. So that's most of the grains as well as the primary oil seeds. And a couple of points that I think are important for us to understand. That first big rise towards the left-hand side, that's the 1970s boom. And we brought considerable amount of land around the world into production. And the very peak of that 1981-82 marketing year, things turned south and sour very quickly. Then after 1980, 1981, and we actually did see then world acreage basically plateau and level off. And so this brings the concept to us that we've known in agricultural production and other industries with high fixed cost, and that is higher prices, as we had in the 70s, bring more supply. They bring more production base in, but then low prices don't get it to move out. And in fact, what caused some of those lows about 1985, 86, 87, probably the biggest thing that caused that was the U.S. federal government, Jason, that basically came in and said, we're going to more intensively get land out of production in the CRP, and that sent a signal we're probably have a base. We're not going to go lower in terms of the ag economy. So what we're still seeing over on the very right-hand side, this magnitude of expansion of acreage this time is just about as big as it was in the 1970s. And then the second point for this year anyway, the 15-16 marketing year, the anticipation is there's still more acreage coming into production. This is sort of that lagging that we get in agriculture, that there's too many projects where in South America clearing land, those are already in place. They're a 3-year project. We continue to see this increase, and we need to level that off reasonably quickly. And I think the final point to make is that we heard a lot of talk in the boom period about demand. And anytime you take an economics course and you're talking about the price, there's more than just a demand curve. You've got to ask, what is the supply? So I think that was the missing element during the boom period, a lack of talking about how quickly can supply meet fully that demand. And basically, that's what we're seeing now. The last 3 years, world supply has exceeded the world demand. Still a lot of demand out there, but the supply has come along to meet that, and you get a moderation in prices.
I think for a lot of us, it's a surprise to see the magnitude of the increase in acreage that's taken place over these last roughly 13 years or so. As you point out, almost 300 million acres picked up over that time frame. We picked up a chunk in the U.S. I think in the U.S. that increase was the three major crops, maybe in the ballpark of about 40 million acres. But a lot of that obviously occurring elsewhere in the world, and that's the part that a lot of us perhaps don't monitor on a routine basis. So big increases.
And really that's South America, and that is Eastern Europe, but surprisingly Africa, China has been aggressive at adding land. So we have competitors. And I think that's something that's the supply side talk. We didn't hear enough of that during the boom period.
Yeah, it took a while to catch up, but it happened.
That's right.
Michael, you've been looking at cash rental rates, and this is based on the Purdue Land Values Survey. Why don't you walk us through that a
the
little
2014, 2015 data and all the data before that is based on the Purdue Land Values Survey. The items in red there are actually my forecasted numbers, and what I've done here is just taken 5% off per year. Using some different models, that seems to be a reasonable adjustment if corn prices stay in that 4 to 4.25 range in the fall of 16, moving into the fall of 17, fall of 18, fall of 19. If corn prices are below that, then these red bars are going to be considerably lower, and so that is premised based on 4 to 4.25 corn prices.
So your analysis, and I guess I've heard this in the country as I travel sometimes, I hear people say cash rents never go down. Your analysis suggests that in the past they have indeed gone down.
Yes.
But the challenge is they tend not to go down as rapidly as the change in revenues might be taking place.
Margins are much more variable historically than cash rents, and so we all know that, and that's what the people are talking about. When you talk to people out in the country, is that scenario. The fact that margins have dropped $150 to $200 in the last couple of years, well, we haven't seen very much adjustment in cash rents. It takes time. It takes time for cash rents to adjust downward. Part of that is because there's uncertainty related to future margins. And so, people that are the landowners, they don't know for sure how what's going to play out, neither do the operators. And so it takes time for the land market to adjust. It adjusts much slower than the margins.
And I think historically, this is kind of what you see, is that you get a stair step.
Yes.
You get a series of years where you're working towards this adjustment, trying to get things back in balance or equilibrium.
The declines were larger in the 1980s. We've talked about that before, and so a harder landing, you're going to see bigger declines on a year-to-year basis, but it was still a staircase scenario. They didn't crash all in 1 or 2 years. It took several years for them to decline, and so that's what I'm illustrating here.
And it was also true on the upside, right? Margins
Yes,
took
absolutely.
off, and it took a while for cash rents to catch up with the dramatic increase in margins. So now we're on the flip side of that, but they are coming down and are likely to continue to come down. On an individual basis, that creates some challenges, all right, because they don't come down automatically. And I think one of the challenges we face is we tend to look at statewide averages, or in this case, West Central Indiana. On an individual situation, how does that occur? It's a negotiation process, right? And in some cases, what it means is some farm operations are going to wind up walking away from some properties because the cash rent is too high, and perhaps that's when that adjustment takes place on that particular property when it changes hands. So there's going to be some real challenges on an individual basis in terms of seeing those rates come down, but we do expect them to see it.
And we've developed some material along those lines, and the key thing to compare there on a track-by-track basis is how much working capital do you have, and how much working capital could you afford to lose in the next 2 or 3 years with the cash rents going down only slightly. And so that's very important to look at that erosion of working capital and seeing if you can afford to pay $267 in 2016. Maybe you're in a situation where your working capital is not particularly strong. You may have to walk away for some tracts because you simply don't have the working capital in order to afford these rents that are way above break even.
Now, in 2018, are you still eroding working capital with the numbers you have there?
You're coming
Or are
much
you
closer
getting
to a
pretty close?
situation where you're not eroding working capital. The big years of eroding working capital are this year and 16 and 17.
And as I look at this, I tend to think about something in the range of a 5-year adjustment period. Not to say that's right, but I think the 14 crop anyway. Maybe it didn't show up in calendar 14, but the 14 crop was the start of that. 14, 15, 16, 17, 18.
Yes.
Now that timing on any cycle you can be off, but that seems very reasonable to me. That this is kind of looking at the dimensions of the time period. But that could be 19 or 20 too, 2019.
Yeah, looking at the information we have and given these declines in cash rents and looking at forecasted prices, that's what we see. Some very large loss in 14, losses in 14, some very large losses in 15 and 16, and then getting closer to break even as we move into 2018. So that's exactly what we see.
Now I'm starting to get the sense that 2017 and 18 will be a crucial time period for agriculture. When we think about the long-term outlook, you look at it from the macro side, we're talking about 17 and 18, and now you're talking about cash rents about 17 and 18. It's one of those, is that one of those years that can be a little stormy?
Yes.
And how do we position agriculture to get ready for that?
Right, and that's exactly right. And one of the things Michael's talking about is the tool we developed to help people look at their cash rent decisions on a quantitative basis so they can make a better choice with respect to what they offer on a farm and whether or not they choose to walk away. So we'll talk more about that in a future webinar, but that's something to keep in mind. Yeah. Michael, you've looked also at farmland prices relative to cash rent, and so let's walk through that a little bit.
Yeah, let's move through this slide fairly quickly because we've showed this in previous webinars before, but this shows that cash rent and farmland are highly correlated. What doesn't show quite as well on this particular slide is that farmland prices went up a lot more than cash rents, and I think on the next slide we illustrate that. And so when we look at farmland price to cash rent multiple, there's a couple things going on. First of all, farmland price did increase faster than cash rent, and so that's why we see this spike going through the average price to rent from essentially from 2000 on. We've seen this spike going up to 2015, and kind of an unprecedented price to cash rent ratio over 30. And so we start to question what's going on here. Why did we see this spike from the early 2000s to 2015? What's missing from this picture is the low interest rates. The fact that cash rents were going up and we had low interest rates meant we had a lot of people looking at the land market and wanting to buy land. And so in West Central Indiana, for example, land prices tripled in the last 10 years, cash rents doubled. And so obviously there was more than increasing cash rents going on in the land market. That's something else was interest rates. Let's move forward, Jason. As we start talking about lower margins, as we start talking about higher interest rates, we're going to see that price to rent ratio come down. But one of the things I want to say about that price to rent ratio, one other thing is ask this question, and maybe the panel asks this: is this the time to buy land given that price to rent ratio?
My perspective, I always look at land, especially as an investor.
Yeah.
It's kind of like a stock. It's an asset like a stock price. And so if you look at that as a PE ratio, that's a pretty high price stock, thinking about where it is right now compared to in different things.
Another thing I note is that there's a lot of trending in that line. That in 1986, 87, once that started to go back up, basically a pretty long run, not a lot of ups and downs. And so with all the fundamentals we're talking about here, this seems like this is a really fundamental change point, inflection point, where it's going to go the other way for a while would be the bet.
Probably for quite a while.
Yep.
Just real quickly on this slide, Jim, a couple things I want to point out. We've talked about the lower margins, so I won't dwell on that too much. But look, just repeating the drop in revenue, it's been close to $300. Looking at 2011 and 2012, $200 to $300 drop in revenue. But I want to really focus on the contribution margin. The contribution margin here in 2015 and 2016 is below $300, right at or below $300. And what the contribution margin is market revenue minus variable costs. Variable costs are fertilizer, seed, repairs, fuel, things that we think of as variable costs. The contribution margin is still positive, and it's quite positive. That means that people are going to continue to produce. This would be the same for soybeans. In fact, the break-even price to cover variable costs for corn and soybeans is $2.50 for corn and under $4 for soybeans. And so we're going to continue to produce corn and soybeans. What's going to happen here is our overhead costs which the contribution margin is needed to, it needs to be large enough to cover. It's not going to be big enough to cover these things. Our overhead costs are land, machinery ownership, and labor. And so these ownership costs are going to have fairly low returns here, probably all the way through 2018. We get closer to a break-even scenario. And so that again adds to the pressure on cash rents if you're renting ground, but also if you own the ground, you're going to get a fairly low return on the ownership of that ground here the next 2 or 3 years. Maybe that's obvious, but it's something that needs to be pointed out. It also points out the fact that you really need to take a close look at your labor and machinery, and you don't want to increase those things. You want to try to use your labor more efficiently if that's possible. I know we've made a lot of progress on labor efficiency in the last 10 to 20 years, but you want to look at that and see if it's a problem on your farm, and also from a machinery standpoint. This is not the time to start increasing your machinery cost or machinery investment per acre.
All right. So Jason, let's talk about the land value scenario a little bit. You've got the capitalization formula on the slide. You want to walk us through that a little bit?
Yeah, so when I look at land values, I look at it in very simple terms. It's the amount of revenue in the capitalization model that you have, whether it's a cash rent or a net return to land. And then you have to account for the capitalization rate to convert it into a future farmland value, or you're trying to discount future revenue streams into what a current price would be. So it's just a basically rule of thumb, revenues divided by an interest rate, your capitalization rate, long-term interest rates going forward. So when I put that together, I tend to look at Indiana's farmland. Hearing certain things are being sold right now for about $10,000 per acre. So given those two moving pieces, cash rents and interest rates, what combination gets us $10,000 acre land? And so when you look at this chart, there's many different combinations. It could be $300 cash rent and a 3% interest rate, or it could be $600 cash rent and a 6% interest rate to get us $10,000. The thing that I'm pointing out these hypothetical scenarios is we've been talking about so far lower cash rents and higher interest rates. That's moving to the southwest corner of that chart. And
what are those prices of land?
Yeah, those prices are not $10,000. And so what we're looking at, both in terms of cash rents and interest rate movements, you're looking at lower farmland values and downward pressure over the next couple of years.
Significantly, right?
Significantly down. And I know that your colleagues here have been working on previous research studies, and in 25 to 30%, potentially in some places.
Land values, yes, from their peaks.
Mm-hmm.
And truthfully, Jason, your chart would suggest the risk is that it could be even larger than that, right?
Well, depending on what the peak is. So, 25 to, we were, noting here in Indiana, some places, land values being sold about $15,000. At least that's what I was hearing of. And I know that, out further west in Iowa, there's some land that was being sold for $20,000. So, if you talk from the peak and down, that's a significant downturn of where it is, and we've probably seen some moderation a little bit already. It's just how much more do we have to go?
So, good point there. One is the distinction between the peak and the absolute peak in land values, whether it was in Indiana, Illinois, or Iowa,
yep,
or if you're measuring your peak as the average value in the state. And Michael, when you talk about land values, you tend to talk about it with respect to the average, right?
Mm-hmm. Yes, and I want to go back to our cash rents going down and interest rates also going up. And so with land values, you not only have the cash rent drop, like you said, Jason, you also have the interest rate increase. And so land values could easily come down harder than cash rents. Mm-hmm. Even having said that, though, if cash rents go down 25 to 30%, 35% would be a pretty large drop in land values. And so maybe 30 to 35% for land values and 25 to 30% for cash rent. But I wanted to make the point that land values could easily come down harder than cash rent because they went up faster.
And I think I just want to reinforce a point that Chris made, is that even with a 25 to 30% decline, that's not a 1980s scenario.
No.
And
that's
so,
right.
so that's a point to need to
You have to
make.
remember that land values tripled in West Central Indiana. And that's not unusual to West Central Indiana. There's many places across the Corn Belt where land values triple. When you take 25% out, you're still talking some fairly high land values compared to 10 years ago.
Good point. Good point. And compared to the 80s, we saw prices from their peak drop.
Average Indiana land dropped 57%. That's a drop of 57%, or they were 43% of what they had been at the peak.
And we're not
So
we're not forecasting that.
not forecasting anything like that. So again, I think it reinforces a moderation, not a total bust.
Michael, some people have asked questions about, well, what's going to be the impact of the government program? Will that help moderate this? You've taken a look at this, and let's walk us through that one.
Let's focus on a couple things here. First of all, when you look at 2015, in many counties, we're going to be looking at the maximum payment. The maximum payment for a lot of counties is $65 to $70, and so for quite a few counties, when you do the numbers across the Corn Belt, not just in Indiana, you're going to get close to that maximum payment. And so that's what the 2015 numbers are reflecting. The payments look like they're going to be smaller in 2016, but there is some factors that may make them a little larger. Depends on what yields are, depends on what the prices look like, so they could be a little larger than that. It is a possibility. I do want to notice here, though, that 17 and 18, I've plugged a lot of numbers into the spreadsheet from Illinois, looking at our county payments and many different scenarios, and I can't get 17 and 18 to have any positive payments. And so 17 and 18, I don't think we're going to see payments. I do want to go back to 14. I think we talked about this in a previous webinar, Jim, but the payments of 14 that just came out recently are going to vary widely across counties in Indiana and across the Corn Belt. And the reason for that is the yield in 2014 varied widely across Indiana. And so the Southwest Indiana that had very strong yields last year, like Knox County, they're probably expecting they're probably going to get a fairly small payment compared to some other counties where yields were not near as good. And so you're going to see that's why I have different counties here. You're going to see variability in our county payments.
Yeah, so it's an important point to remember. Previous farm programs payments were based on changes in prices only.
Yes.
This one's based on change in revenue, and it's done on an individual county basis, and that brings that county yield in and makes that a very important determinant of what those payments are. And you can have much different payments in two counties that adjoin each other, and we're seeing some evidence of that already in 14. We're likely to see that the next couple of years. But if you look at the numbers on the left-hand side of that graph, Michael, it doesn't look to me like those numbers are big enough to offset the kind of losses that you've been talking about.
No, not even close. I mean, I don't want to be too negative here because they help.
Yep.
They help considerably, and same with crop insurance. I mean, there's going to be many counties in Indiana where the corn yield in particular is going to be relatively low, and particularly on certain farms, and so it's very helpful. But it's not going to negate the losses that we're seeing.
And I'd like to say that here again, the point is they're not big enough, but do you want to take those away? And this is helping bridge over to where we're going.
Yeah.
And it is important for a lot of farm families.
And the timing is good because 15 and 16 are probably going to be look like they're going to be the worst years in terms of earnings, and so the timing is really good here.
And it's why I think a lot of people did look at the county ARC programs because the payments looked like they would come early when we really needed it, and then we'd have more time to make adjustments later on. PLC in some cases looked better when you got prices lower later on.
Yeah.
So again, it's helping to bridge. It's helping, but it's not a full-fledged bridge to keep everything level over these years.
And I guess one other point to remember is that although you've labeled those according to the year in which the payments are attributed, the 14 payments are actually coming out right now here in the fall of 15. Those 15 payments will come out in the fall of 16. And the 16 payments will actually show up in the fall of 17, which again I think reinforces your point, Chris. It does provide a cash flow bridge for some people, obviously. Michael, you've looked at this in a little more detail, looking ahead to 2016. Walk us through this chart. This is kind of complicated, so walk us through.
Yes, it is. And I want to focus on the base price here. That's kind of the long-run forecast using FAPRI or USDA forecast information. So let's focus kind of on the base price there, and let's look at different yields. Let's start with base yield and 10% higher because those are probably the most likely. If you were doing budgeting, you'd probably budget for a base yield, a trend yield. And so that's the yellow bar and the base price there. Using that yellow bar, we're expecting losses with government payments, with expected crop insurance proceeds to be around $125 loss per acre. And so that's the yellow bar with the base price there. If we have lower yield, yes, with crop insurance kicks in, but even when we have lower yields, it could be as low as negative $200. And so, certainly we hope 2016 we don't see a drop of yields of 20 to 30%. And so what I want to illustrate here is crop insurance helps, but you're still going to have some pretty big losses, even with the crop insurance, if we have relatively low yields in 2016. And so that's what I'm trying to illustrate here. Another point, and we were talking about this earlier, Chris, is you got to have a pretty rosy scenario of high yields and high prices in order to get close to that break even. And so that's probably not very likely. And so that's why we keep talking about this $100 to $150 range in terms of losses.
You've also taken a look, Michael, at some prices paid, and
Yes.
the argument here is, do costs ever go down? And you've taken a look at that in more detail.
We've talked about before that revenue comes down faster than cost. That's true with any cost. I mean, we focused on cash rent, but there's other costs that come down too sometimes, like fertilizer, for example, came down the last year. And so there is instances where costs actually come down. I mean, sometimes people think, well, costs only go one direction, that's up. That's because that has been the direction they've been going up here for several years. But when you have very low margins like we have in 15 and 16 here, it's certainly possible for costs to come down, and I think they will to some extent. We focus on cash rent because that's one of the cost items that's probably going to be the closest in terms of scrutiny. It's the highest cost item when you look at a corn budget, and particularly on a soybean budget, and so that's a cost that people focus on. But there's other costs here that we're also going to need to look at and make sure that there's not some way that we can become more efficient and reduce those individual costs.
So your G equals 3.3% up there is suggested over the life of that data set. There's a tendency for those costs to go up at a rate of about 3.3% compounded annually,
Yes.
right?
Oh, wow.
But if you look at it more closely and look at the red triangles, that's your point, is that there are periods when margins are under severe pressure that we do in fact see those costs go down, and that's what's
And I
likely
think the
to happen.
reason why people are saying that costs don't come down very frequently is because it's been a while since they've came down. That's number one reason. It's really been since the late 1990s. But also, if you look at those red triangles, costs have been increasing about over 5%, closer to 6% in the
recent years,
in the last 10 to 15 years. And so that's what we've gotten used to, is these very high cost increases in the last 10 to 15 years. Well, we're in a different environment that we've been in the last 10, 15 years. And so we're much more similar to the late 1990s, where we had some prices that were relatively low. We're much closer to that scenario than where we've been the last 10 to 15
And again,
years.
in this boom period where those triangles are above your trend line, that boom period's a demand pull.
Yes.
So much demand for fertilizer around, so much demand for new
Good
genetics.
point, Chris.
And you would expect that to be a period when you can get above the general inflation rate. But that's not the period we're coming into.
No, it's
That's
not.
right.
Demand would pull those down.
Chris, we focused most of our attention so far on the crop side. It's time to talk a little bit about the meats, and I'm going to let you talk a little bit about the changes that have taken place here.
Yeah, and I think 2 years ago we were talking about getting these moderation in feed prices, corn and soybean meal. We're going to moderate finally and give the livestock industry and the animal industry a chance to have really good series of years of profitability. So how has that plan panned out? It's changed a little bit. The very high feed cost caused big losses in the animal sector, and they reduced production overall, or availability of meats that we're seeing here in this chart. From 223 pounds of meat available, poultry and red meats, back in 2007, that was your $2 corn era producing that amount of meat. We dropped then by 14. 2014 is the low weather mark at 203 pounds, 20 pounds less meat. That was a record profit year, record price year for across our animal species. Surprisingly now, in 1 year, we've added 9 pounds to that. That's the 212 pounds. And I think a quicker response and some trade issues coming in here that have gotten more available meat into the United States. But here we are seeing, as we project on out for 17 and 18, 16, 17, 18, is a stair-stepping up of those available supplies. What does that mean? A stair-stepping down in prices of our animal products And what that probably means is tightening of margins, that we're not going to get that 2, 3, 4 years of really strong margins in the animal sector. We pretty quickly, within 1 year or 2 years, have are replenishing and getting back to fairly break-even situations for animals.
Yeah, so meat supplies have come up more quickly than we thought. Part of that was on the international trade side. We saw, particularly in beef, for example, we saw increased imports and reduced exports. We added 1 billion pounds on the beef side there. But also on the chicken side. You know, when you look at those per cap numbers, I think you said the per caps supply up about roughly 9 pounds.
Right.
Between 5 and 6 pounds of that came out of the poultry sector.
Right. Yes.
So the poultry sector has really rebounded very strongly. We anticipated that, but truthfully, it's come back even stronger, at least than I thought.
Right.
And I think if you talk to some of the industry people, they expect that continued expansion going forward in the next couple of years.
And so essentially that period, that multiple years of profitability for the animal sector, I think not that we're going to have losses, but that it's just not going to be as robust and as long as we thought it would be. And part of that's the trade issue.
Yeah, and it's not going to offset as much of the losses that we're experiencing in the crop sector for when you look at the U.S. ag sector as a whole as perhaps we thought a year ago.
Yeah, and I think that's what we'd say. We had been talking a year ago, the crop sector was going to be weak in terms of incomes, but we'd get that offset some by the animals, which we did last year in 14. Now it's looking more like going forward, you've got a weak crop sector and not a very strong livestock sector.
Certainly not as strong as we thought,
Not
and
as
perhaps,
what we thought.
and probably not as strong as we had hoped, perhaps.
But one qualifier there, I mean, certainly if a producer's in a contract situation, that's going to be very beneficial, from kind of helping support
Offset,
their,
yeah.
Absolutely.
Support their
As
income.
long as the integrator
Yes.
can make it and make those payments. Here we're just looking at the yellow highlighted areas are the peak prices. Those all came in 2014 for these various livestock products, animal products, except for eggs and turkey. That's the influence of avian influenza and actually is making this year, 2015, peak prices. But the other part of that is to say then what you're looking at is a stair step down of prices as we go through 2016 and probably into 2017. And that says that we're largely getting back to a break-even situation. Not a lot of profitability in the animal sector either.
And with that, I think, Chris, our time is about up, and I guess I want to just conclude by pointing out that we've got another webinar coming up, and what we're going to do in that next webinar is really build on some of the things we've talked about today and actually think about some strategies. We didn't have time today to really explore some management strategies. Today we kind of laid out a likely scenario over the next several years, and going forward we'll have a chance to think about, okay, how can you respond to this and how can you prepare and put yourself in a position to be successful in the next several years. So joining us on that webinar will be Michael Langemeyer and Dr. Mike Bolge, and so we're looking forward to that discussion on the November 30th, which will be right after Thanksgiving. So we'll look forward to that. Thank you for joining us again today on our webinar. If you want to catch a recording of this, that'll be available later. And if you registered for this webinar, you'll get an email letting you know the availability of that recording. You'll also be able to download a PDF copy of the slides that we used today if you want to look at some of the charts in a little more detail. So on behalf of Purdue Extension, on behalf of the Purdue Center for Commercial Agriculture, I want to thank you for joining us today and wish you a good rest of the day. Thank you.